If you are over the age of 62, the Internal Revenue Service has quietly set a trap that is currently seizing an average of $3,214 from retirement accounts this year. And the worst part? Most retirees trigger it themselves by making one seemingly innocent mistake with their hard-earned savings. You spent 40 years playing by the rules. You worked hard, you sacrificed, you saved diligently in your 401k, and you paid your taxes every single year. But right now, there is a complex web of stealth taxes written directly into the federal tax code, and it is specifically designed to target middle-class and upper-middle-class seniors who did exactly what they were supposed to do. I am talking about hidden income thresholds that can instantly subject up to 85% of your Social Security benefits to federal income tax. I am talking about phantom surcharges that can double or even triple your monthly Medicare premiums overnight. Over the next few minutes, I'm going to walk you through exactly how these devastating financial traps work, why the government's 2026 tax code adjustments are making the situation significantly worse, and the precise legal steps you need to take right now to protect your nest egg from being drained. We will cover the notorious tax torpedo, the 2-year Medicare lookback trap that actually starts catching you at age 63, and the ultimate defense strategy you absolutely must deploy before December 31st of this year. Listen closely, because what you do not know about how the IRS defines your retirement income is already costing you a small fortune. Let us start with the single biggest shock that hits new retirees. It is officially known as the taxation of Social Security benefits, but financial planners call it the Social Security Tax Torpedo. For decades, you paid into the Social Security system through payroll taxes. You were taxed on that money before it ever hit your bank account. So logically, you might assume that when you finally start collecting your benefits, that money would be tax-free. That is what most people think, and unfortunately, that is completely wrong. Back in the 1980s, the government decided they needed more revenue, so they introduced a formula to tax your benefits. But they did not use your normal tax bracket. Instead, they created a completely separate, highly confusing metric called provisional income. Your provisional income is calculated by taking your adjusted gross income, which includes your pension, your wages if you are still working, your traditional IRA withdrawals, and your 401k distributions, and then adding any non-taxable interest you might have, such as municipal bond interest. Finally, you take exactly 1/2 of your annual Social Security benefit and add that to the pile. This grand total is your provisional income. Now, here is where the trap snaps shut. If you are single and your provisional income is between $25,000 and $34,000, up to 50% of your Social Security benefits become taxable. If you go over $34,000, a staggering 85% of your Social Security benefits are thrown into your taxable income. For married couples filing jointly, the numbers are barely any better. If your provisional income is between $32,000 and $44,000, 50% is taxed. If you cross that $44,000 line, up to 85% of your benefits are suddenly taxable. Think about those thresholds for a moment. $34,000 for a single retiree, $44,000 for a married couple. Those limits were written into the tax code decades ago, and unlike almost every other part of the tax code, they have never once been adjusted for inflation. Not once. Because of decades of inflation and the massive cost of living adjustments we have seen recently, including the 2.8% bump in 2026, almost every middle-class retiree now easily breaches those thresholds. The government has essentially used inflation as a hidden tax hike to drag millions of seniors into this trap. But why is it called a torpedo? Because of the double taxation effect. Let me paint a picture for you. Let us say you are a married couple and you need a little bit of extra cash to pay for a home repair, maybe a new roof or an unexpected medical bill. You decide to pull an extra $1,000 out of your traditional IRA. You expect to pay your normal tax rate on that $1,000. Let us say 12% or $120. That is painful, but you accept it. However, because you are sitting right on the edge of the provisional income threshold, taking that $1,000 out of your IRA does not just trigger taxes on the IRA withdrawal. It also pushes another $850 of your previously tax-free Social Security benefits into the taxable category. Suddenly, by taking out $1,000, you are being taxed on $1,850 of income. Your effective tax rate on that withdrawal does not just jump a little bit, it skyrockets. You end up paying nearly 30 or 40% in federal taxes on that single $1,000 withdrawal, even if you are supposedly in a low tax bracket. That is the tax torpedo. It sinks your spending power from beneath the surface, silently eroding your wealth every single time you take a distribution from your life savings. Let me ask you a question. Have you ever looked at your tax return at the end of the year and wondered why earning just a tiny bit of extra interest from a certificate of deposit or a bond suddenly caused your total tax bill to jump by hundreds of dollars? That is the torpedo in action, punishing you for having a little bit of extra income. Now, as devastating as the tax torpedo is, it is only the first layer of the trap. The second layer is arguably even more insidious, and it revolves around your healthcare. It is called the Income-Related Monthly Adjustment Amount, or IRMAA. IRMAA is essentially a penalty surcharge that the government slaps on top of your standard Medicare Part B and Part D premiums if they decide you make too much money. In 2026, the standard Medicare Part B premium sits at $202.90 per month. For many retirees, that standard premium is automatically deducted from their Social Security checks, offsetting the meager cost of living adjustments they just received. But if you trigger the IRMAA trap, your premiums explode. Here is exactly how the government sets this trap. In 2026, the IRMAA threshold for a single filer is $109,000 of modified adjusted gross income. For a married couple filing jointly, the threshold is $218,000. If your income stays exactly at or below $218,000 as a couple, you pay the standard base premium. But IRMAA operates on what financial experts call a tax cliff. This is not a gradual phase-in. If you earn just one single dollar over that threshold, if your joint income hits $218,001, you fall straight off the cliff. You are immediately penalized. Your Medicare Part B premiums instantly jump from $202 to $284 per month per person, and you are hit with an extra $14.50 monthly surcharge on your Part D prescription drug plan. For a married couple, going over the limit by $1 costs you roughly $2,300 in extra unrecoverable Medicare premiums for the year. And that is just the first tier. If your income bumps into the next brackets, which top out at $342,000, $410,000, and eventually over $750,000, the penalties get exponentially worse. At the higher brackets, your monthly Part B premium shoots up to $527 or even $649 per month. A married couple in the higher brackets could easily be paying $10,000 or more every single year just for basic Medicare coverage. But here is the truly terrifying part about IRMAA and the reason why this trap catches people starting at age 62. Medicare does not look at what you are earning this year to determine your premiums. They use a 2-year look-back period. That means your Medicare premiums for the year 2026 are based entirely on the tax return you filed for the year 2024. Let that sink in. The financial decisions you make 2 years before you even enroll in Medicare will dictate how much you pay for healthcare. If you plan to retire and start Medicare at age 65, the IRS is looking closely at everything you do during the year you turn 63. This catches hundreds of thousands of seniors completely off guard. Imagine a man named David. David decides to retire at age 63. To celebrate and to downsize his life, he sells his large family home. The housing market has been hot, so he realizes a significant capital gain on the sale of the house. Or perhaps David cashes out a large chunk of his stock options from his former employer to buy an RV. In the year he turns 63, David's income temporarily spikes well above the $109,000 threshold. The next year, his income drops back down to a very modest $40,000. David thinks he is fine. But 2 years later, when he turns 65 and enrolls in Medicare, he is suddenly hit with a massive IRMAA surcharge. He calls the Social Security Administration, completely confused, explaining that he is on a fixed income of $40,000 a year. And the government replies, "We do not care about your income today. 2 years ago, you sold a house, and therefore you are rich, and you must pay the maximum penalty." Here is a staggering statistic for you to consider. Nearly 10% of all Medicare beneficiaries are now paying these inflated IRMAA premiums, and the vast majority of them had absolutely no idea it was coming until the dreaded letter from Social Security arrived in their mailbox. They thought they were simply taking a one-time withdrawal to pay off their mortgage or buy a car, completely unaware that the IRS was documenting that withdrawal to weaponize it against their healthcare costs 2 years later. This brings us to the most heartbreaking trap of all, one that no one wants to think about, but almost everyone will eventually face. It is called the widow's penalty. When a husband and wife retire, they plan their finances around the married filing jointly tax brackets. They get the highest standard deduction, they get the most generous provisional income thresholds for Social Security taxation, and they get the spacious $218,000 threshold for Medicare IRMAA before the surcharges kick in. Everything is optimized for two people, but life happens. Eventually, one spouse passes away. When you lose your spouse, you suffer a massive emotional blow. But the IRS wastes no time delivering a devastating financial blow right on top of it. In the year following your spouse's death, your tax filing status officially changes to single. Suddenly, your standard deduction is cut in half. The amount of income you can earn before triggering the Social Security Tax Torpedo plummets from $44,000 down to $34,000. And your safe zone for Medicare IRMAA shrinks drastically from $218,000 down to $109,000. Now, your household income will decrease somewhat when a spouse dies, because you will lose the smaller of your two Social Security checks. But in most cases, your household income does not drop by 50%. If you had a pension, that pension usually continues to the survivor. If you had traditional IRAs and 401ks, the surviving spouse inherits those accounts and must continue to take the taxable withdrawals. So the widow or widower is left with roughly 70 to 80% of the income they had when they were married, but they are now being shoved into tax brackets that are 50% smaller. The result is a massive immediate spike in taxes. A widow who is living comfortably within the 0% or 12% tax bracket with her husband can suddenly find herself thrust into the 22 or 24% bracket. Her Social Security benefits suddenly become fully taxable under the torpedo formula, and she is suddenly pushed over the cliff into the IRMAA penalty zone, causing her Medicare premiums to double exactly when she is adjusting to life on her own. The widow's penalty is one of the most cruel and hidden mechanics of the American tax system, and if you do not plan for it while both spouses are alive and healthy, it can absolutely decimate the surviving spouse's quality of life. I'm going to share a comprehensive strategy with you in just a moment that completely neutralizes these traps, a perfectly legal framework the IRS hopes you never use. But before we get to that ultimate payoff, we absolutely have to talk about the silent engine that powers all of these traps. It is the inescapable force that pushes you into the torpedo, pushes you over the IRMAA cliff, and maximizes the widow's penalty. I am talking about required minimum distributions, or RMDs. For decades, the government gave you a massive tax break to put your money into traditional IRAs, 401ks, and 403bs. They let your money grow tax deferred. But the government was not doing this out of the goodness of their hearts. They were simply letting the cattle fatten up before the slaughter. They always intended to get their cut, and their mechanism for forcing you to pay up is the required minimum distribution. Under current law, once you reach age 73, you are no longer in control of your own money. The IRS steps in and dictates exactly how much money you must withdraw from your tax-deferred accounts every single year, whether you actually need the money to live on or not. Let us say you have been a diligent saver and you have accumulated $1 million in your traditional IRA. At age 73, the IRS forces you to withdraw roughly $36,000. By the time you are 80, that forced withdrawal jumps to over $50,000. And remember, every single penny of a traditional IRA withdrawal is taxed as ordinary income. This is where the entire trap comes together. You might be perfectly happy living on your Social Security, a modest pension, and your non-taxable savings. You might be keeping your income beautifully low, avoiding the torpedo, and dodging the IRMAA surcharges. But the moment those RMDs kick in, a massive wave of taxable income is artificially injected into your tax return. That forced $36,000 withdrawal instantly drives up your adjusted gross income. That higher AGI flows directly into the provisional income formula, instantly triggering the taxation of 85% of your Social Security benefits. That exact same AGI flows directly into the Medicare lookback formula, pushing you right over the cliff and doubling your Medicare Part B and Part D premiums. You are hit with 3 simultaneous financial penalties, all triggered by a withdrawal you did not even want to take. And if you think you can simply refuse to take the required minimum distribution, think again. The IRS imposes a massive penalty for failing to take an RMD. It used to be 50%, and while recent legislation lowered it to 25%, and sometimes 10% if corrected quickly, it is still an absolutely draconian fine. They will force you to take the money out, and they will force you into the higher tax brackets. So how do you fight back? How do you defuse the Social Security Tax Torpedo? Sidestep the 2-year Medicare lookback, protect your spouse from the widow's penalty, and completely eliminate the threat of required minimum distributions? The answer lies in the single most powerful tool available to the American taxpayer. And right now, we are sitting in a rapidly closing window of opportunity to use it. The solution is proactive, calculated Roth conversions. Unlike a traditional IRA, where the money is taxed when you take it out, a Roth IRA is funded with after-tax dollars. The beauty, the absolute magic of a Roth IRA is that once the money is inside, it grows completely tax-free forever. And more importantly, when you pull the money out of a Roth IRA in retirement, it does not count as taxable income. Let me repeat that because it is the key to your financial survival. Roth IRA distributions are invisible to the IRS when they calculate your taxes in retirement. If you pull $50,000 out of a Roth IRA, your adjusted gross income does not go up by a single penny. Because your AGI does not go up, your provisional income does not go up. Because your provisional income stays low, your Social Security benefits remain entirely tax-free, entirely avoiding the tax torpedo. Furthermore, because your AGI stays low, you remain safely below the IRMAA thresholds, guaranteeing that you pay the absolute lowest base premium for your Medicare Part B and Part D coverage. And because Roth IRAs do not have required minimum distributions during your lifetime, the government can never force you to take money out when you do not want it. You are in total, absolute control of your cash flow. If one spouse passes away, the surviving spouse inherits the Roth IRA tax-free, completely neutralizing the dreaded widow's penalty because the money they pull out to survive will not push them into higher single-filer tax brackets. But you cannot just snap your fingers and turn your traditional IRA into a Roth IRA. You have to convert it, and when you convert it, you have to pay the income tax on the amount you move over. This is where strategy is critical. The goal is not to convert your entire $1 million IRA in a single year, because that would push you into the highest possible tax bracket and trigger every penalty in the book. The strategy is to perform systematic, multi-year Roth conversions during your gap years. Your gap years are the years between the day you retire and the day your required minimum distributions begin. For many people, this is the window between age 60 and age 73. During these years, your wage income has stopped, which means your tax bracket is naturally at its lowest point. This is the perfect time to look at the tax brackets and selectively fill them up. If the top of the 24% tax bracket is $200,000 and your current income is only $80,000, you have $120,000 of space available in that relatively low bracket. You purposefully convert $120,000 from your traditional IRA to your Roth IRA, paying the known historically low tax rate today. You do this year after year after year. Yes, you are paying taxes now, voluntarily, but you are paying them on your terms at a controlled rate to permanently insulate that money from the torpedo, from IRMAA, and from future mandatory withdrawals. And timing has never been more critical than it is right at this very moment. In 2017, the Tax Cuts and Jobs Act dramatically lowered federal tax brackets. But those tax cuts were not permanent. By law, they are scheduled to sunset and expire at the end of 2025, which means starting in 2026, tax rates are automatically going back up. The 12% bracket will revert to 15%. The 22% bracket will jump to 25%. The 24% bracket will skyrocket to 28%. We are living in what is mathematically proven to be one of the lowest tax environments in modern American history. The window to move your money from tax-deferred, government-controlled accounts into tax-free, heavily protected Roth accounts at a discount is slamming shut. Every dollar you leave in a traditional IRA is a dollar that will be taxed at higher rates in the future, subjected to the tax torpedo and monitored for Medicare surcharges. You must sit down with a fiduciary, a tax planner, or a financial advisor who understands the intersection of taxes and retirement, and you must calculate exactly how much you can convert this year without tipping over the IRMAA cliffs. It is a mathematical balancing act. You convert right up to the edge of the $109,000 or $218,000 IRMAA limits, and you stop. You wait until January 1st, and you do it again. By the time you reach age 73, your traditional IRA balance will be significantly reduced or entirely depleted, leaving the IRS with absolutely nothing to force out of you. Let us briefly recap what we have covered, because the stakes are too high to misunderstand this. First, the Social Security Tax Torpedo is a hidden formula that uses your own savings to suddenly make up to 85% of your Social Security benefits taxable. Second, the Medicare IRMAA trap uses a rigid 2-year lookback period, meaning the financial moves you make at age 63 will directly dictate the healthcare premiums you are forced to pay at age 65. Third, required minimum distributions act as a forced income pipeline, guaranteeing that you will trigger these traps once you hit age 73, whether you want to or not. And finally, the only mathematical escape hatch is utilizing targeted Roth conversions right now, paying taxes at today's historic lows so that your retirement income becomes virtually invisible to the IRS tomorrow. You have worked entirely too hard for your money to let it be drained away by hidden formulas and stealth surcharges that you did not know existed. This is your retirement, and you have to defend it. Take control of your tax situation before the government takes control of it for you. I want to hear from you. Let me know in the comments below. Have you personally been hit by a surprise IRMAA surcharge in the mail? Or have you experienced the shock of the Social Security Tax Torpedo when filing your returns? Share your story in the comments so others can learn from what you went through, and let's start a conversation about protecting what is rightfully ours.